Hello, everyone. Today, markets received a very clear relief signal. Wall Street rose, bonds rose, oil fell, but at the same time, the dollar strengthened. So the message from the market is not one dimensional. On one side, we have lower energy risk after the Strait of Hormuz started to reopen. On the other side, we still have a Fed that is keeping a more hawkish rate scenario on the table. That is why today's main question is this: is the market entering a new phase of risk appetite, or is it simply pricing a short-term relief move driven by lower oil prices? Today, we will look at this question across US markets, Europe, oil, gold, the dollar, Bitcoin, and the key technical levels. Wall Street staged a strong rebound overnight. The S&P 500 rose 1.1%. The Nasdaq 100 gained 2.5%. The semiconductor index jumped 6.4%, delivering one of the strongest moves of the session. The performance of chip stocks is especially important here, because as risk appetite returned to the market, the strongest buying pressure was once again concentrated in technology and semiconductors. The Dow Jones Industrial Average did not participate with the same strength and rose only 0.1%. This tells us something important. There is a rebound, but it is not evenly distributed across the whole market. Growth, technology, and the semiconductor theme are leading the move. Another important part of the S&P 500 move was trading volume. With around $7.5 trillion of options expiring, trading volume reached a record level. On days like this, price action is not shaped only by macro headlines. It is also driven by position closing, portfolio rebalancing, and technical flows linked to expiry. So it would be incomplete to say that the market simply became optimistic overnight. Yes, the main story is the relief around Hormuz and oil. But the heavy positioning flow in futures and options markets also amplified the move. The main development that relieved markets was the temporary peace agreement between the United States and Iran. This agreement reduced the threat around the Strait of Hormuz. After the ceasefire came into effect, ship traffic began returning to the Strait of Hormuz. Washington also announced that it had ended the blockade. Why is this so important? Because in recent days, the market was not only pricing geopolitical risk, it was pricing the possibility that this risk could turn into a new inflation shock through energy prices. If oil flows normalize, pressure on energy costs declines. If pressure on energy costs declines, forward inflation concerns also soften. BMO Capital Markets highlighted this exact point. Expectations for freer oil supply from the Persian Gulf supported equities and pushed long-term treasury yields lower as forward inflation concerns eased. The 10-year US Treasury yield fell 3 basis points to 4.45%. This is where we need to make an important distinction. The decline in oil prices relieved the market, but the Fed risk has not disappeared. Fed Chair Kevin Warsh emphasized this week that he is committed to restoring price stability. Officials kept interest rates unchanged, but they also signaled that support for rate hikes has increased, so the Fed's message is still cautious and close to a hawkish tone. Forex.com's view is important here. If the decline in energy prices continues to feed into inflation data, the central bank may prefer to keep rates at current levels instead of raising them. That sentence is critical for markets, because for today's rebound to continue, it is not enough for oil prices to fall. That decline also needs to soften the Fed's rate path. Several company-specific stories stood out. Intel shares rose after Trump said the chipmaker would design and manufacture semiconductors in the United States together with Apple. That news became one of the key parts of the strong move in semiconductors. SpaceX shares declined for a second consecutive day. That move showed that even the largest initial public offering in history can still be affected by post-IPO volatility. It was also reported that investment banks were organizing investor meetings for a possible bond sale. There was another important development on the Amazon side. Amazon was reported to be in talks to sell its own artificial intelligence chips for use in rival data centers. That would represent a direct challenge to Nvidia. Accenture, on the other hand, had a more negative impact on sentiment. The company warned that its revenue outlook had weakened because artificial intelligence is transforming the consulting industry and tensions in the Middle East are slowing client activity. So the message on the equity side is clear. The artificial intelligence and chip theme remains strong, but artificial intelligence is also starting to pressure the business models of some sectors. While risk appetite strengthened in the United States, Europe showed a weaker picture. The Stoxx Europe 600 ended its 5-day winning streak and fell 0.3%. Energy companies led the decline. After the ceasefire, Brent crude fell back below $78. As a result, Shell, BP, and Total Energies each lost more than 2.5%. There is an interesting divergence here. In the United States, lower oil prices are read positively because they ease inflation expectations. But in Europe, lower oil prices put direct pressure on energy stocks and drag the indices lower. Technology services were also weak. Accenture's warning on its revenue outlook spread across the sector, and Capgemini shares fell 9%. In London, the FTSE 100 declined 1%. The Bank of England kept its policy rate unchanged at 3.75%. It described the recent decline in oil prices as a positive development. However, 2 of the 9 committee members voted for an immediate 25 basis point rate hike because of ongoing inflation concerns. That shows that central bank relief in Europe remains limited as well. 2 company-specific moves stood out in Europe. London Stock Exchange Group shares fell 7% after a broker downgraded its recommendation to neutral. By contrast, French employee benefits company Edenred rose 17%. That move followed reports that the company had received a takeover offer from investment funds and that there was interest in the company. So even though the broad European index was under pressure, stock-specific divergence continued. On the commodities side, oil remained the main story of the day. Crude prices declined as the Strait of Hormuz reopened and investors priced the normalization of oil supply from the Persian Gulf. WTI crude closed around $76 per barrel. Brent crude fell back below $78. This decline reduced pressure on energy costs and the inflation outlook. Gold showed a different picture. Spot gold fell 0.9% to $4,216 per ounce as US rate expectations strengthened. In foreign exchange, the dollar gained ground. The Bloomberg Dollar Spot Index rose 0.3% and reached its highest level in 1 year. The euro fell 0.4% to $1.1460. Sterling lost 0.7% and declined to $1.3205. The Japanese yen weakened 0.5% against the dollar to 161.43. The Australian dollar briefly fell below 70 US cents in offshore trading before stabilizing around 70.22 cents. Crypto also weakened. Bitcoin fell 1.9% to around $63,124. Ethereum declined by the same amount. So while risk appetite recovered in equities, the message from currencies and crypto remained more cautious. Now let's move to the technical picture. The S&P 500 maintains a bullish structure on the daily chart. The index is trading around 7,488 and remains above all 3 key moving averages. The 14-day TMA is at 7,460. The 50-day TMA is at 7,341. The 200-day TMA is at 6,918. This structure shows that short-term, medium-term, and long-term momentum are all aligned to the upside. On the daily chart, the first resistance is 7,600, followed by the 7,750 area. The first support is 7,460, followed by 7,341. The most critical level here is 7,460. A daily close below the 14-day TMA would indicate weakening short-term momentum. On the 4-hour chart, the outlook is sideways. Price is around 7,488. The 14-period TMA is at 7,499. The 50-period TMA is at 7,444. The 200-period TMA is at 7,450. That makes the 7,444 to 7,450 range a very important short-term support area. Closes above 7,499 could trigger renewed upside momentum and bring the 7,600 target back into focus. For the DAX, the daily picture remains bullish. price is around 25,057. The 14-day TMA is at 24,736. The 50-day TMA is at 24,507. The 200-day TMA is at 24,224. Because the index remains above all three moving averages, the long-term outlook is still positive. The first resistance is 25,500, followed by 26,000. The first support is 24,736, followed by 24,224. On the 4-hour chart, the picture is more sideways. The 14-period TMA is at 24,921. The 50-period TMA is at 24,696. The 200-period TMA is at 24,681. That makes the 24,681 to 24,696 range a strong short-term support zone. The main message for the DAX is this: the daily trend remains upward, but in the short term, momentum may cool, and the probability of sideways consolidation has increased. The gold picture is clearly weak. On the daily chart, price is around 4,186 and trades below all major moving averages. The 14-day TMA is at 4,293. The 50-day TMA is at 4,541. The 200-day TMA is at 4,463. The break below the 200-day TMA is especially important because it signals a structural breakdown. Daily resistance levels are 4,293 and 4,463. Support levels are 4,100 and 3,950. The 4-hour chart also confirms the bearish picture. Price is around 4,187. The 14-period TMA is at 4,291. The 50-period TMA is at 4,255. The 200-period TMA is at 4,478. The SMI indicator is in deeply oversold territory, but there is still no confirmed reversal signal. So the main direction in gold remains downward. If the 4,100 support breaks, the 3,950 level may come into focus. Upside rebounds are likely to remain corrective unless gold can reclaim the 4,255 and 4,291 resistance levels. WTI crude oil also shows a bearish technical structure. On the daily chart, price is around 76.85. The 14-day TMA is at 87.13. The 50-day TMA is at 95.44. The 200-day TMA is at 74.46. The fact that price remains far below the 14-day and 50-day averages shows that downside momentum is strong. But the 200-day TMA at 74.46 is critical. A daily close below this level could bring the $70 area into focus. On the 4-hour chart, price is around 76.87. The 14-period TMA is at 76.80. The 50-period TMA is at 84.07. The 200-period TMA is at 94.90. In the short term, 76.80 is the nearest resistance. 84.07 is the stronger resistance area. The main message for oil is this: as the Hormuz-related risk declined, prices pulled back. The technical picture currently confirms that pullback. Euro/dollar also shows a bearish structure. On the daily chart, price is around 1.1461. The 14-day TMA is at 1.1552. The 50-day TMA is at 1.1659. The 200-day TMA is at 1.1672. Price is below all three moving averages. That makes 1.1552 the first resistance level. The 1.1659 to 1.1672 area is a stronger combined resistance zone. On the downside, the first support is 1.1400. If that level breaks, 1.1200 may come into focus. The 4-hour chart also confirms the bearish view. Price is around 1.1461. The 14-period TMA is at 1.1536. The 50-period TMA is at 1.1558. The 200-period TMA is at 1.1631. For a short-term rebound to become meaningful, price needs to move above the 1.1536 to 1.1558 range. Otherwise, 1.1400 and then 1.1350 remain the key support levels to watch. Today's market story is clear. The reopening of the Strait of Hormuz reduced energy risk. The decline in oil prices eased the risk of a new inflation shock. That triggered a strong rebound on Wall Street. But there is a second side to the story. The dollar reached its highest level in 1 year. Gold declined, Bitcoin fell, the euro and sterling weakened, and the possibility of a Fed rate hike has not completely disappeared. So the market's message is this: there is relief, but not unconditional risk appetite. The S&P 500 and DAX still preserve their bullish technical structures. Gold, WTI crude oil, and euro/dollar remain in bearish structures. The key equation from here will be this: will lower oil prices soften inflation expectations enough? Will that allow the Fed to hold rates instead of raising them? And can equities turn this relief into a move toward new highs? Markets found relief today, but whether that relief becomes durable will not depend only on the ceasefire. Oil, the Fed, and the dollar must all be watched at the same time. In this video, we looked at the market impact of the reopening of the Strait of Hormuz, the decline in oil prices, the Fed's rate message, and the technical outlook for the S&P 500, DAX, gold, WTI, crude oil, and euro/dollar. Do you think this rebound marks the start of a lasting return in risk appetite? Or is it only a short-term relief move driven by lower geopolitical risk? Share your view in the comments. Do not forget to follow the channel and like the video. See you in the next market update.